Joining us now, Anastasia Amoroso, Chief Investment Strategist for Private Wealth at Partners Group. And it's good to see you. Your forecasts and your feelings about the S&P are, it's like deja vu all over again. A lot of people, 76 to 7,700.
That's right.
Not quite double-digit return, 9% return. So right. back to a decent year, but not like the last couple years.
That's right. But to be fair, I feel like that was a forecast, 8 or 9% or 10% for the S&P for the last few years. And we've managed to surpass those forecasts because multiples kept expanding and also earnings kept overshooting expectations.
Is it a safe forecast, Anastasia, or do you have...
Based on the numbers, I feel like it is a reasonable forecast because we're assuming the multiple is going to stay where it is today. The Fed is going to continue to deliver some support for the labor market and the economy. And at the same time, the earnings growth is going to come through at 12% this year and about 10% the following year. So you square all of that, and that's how you get to that 7,700. Look, other than the endpoint estimate itself, I will say there are a lot of positives that are lining up for the market and for the economy. I mean, on the earnings growth front, I want to bring up one point, which is around AI and productivity. We get the new productivity print on Thursday, and the estimates are looking for 5% quarter-over-quarter increase, which I think is like the best in 20 years. So we are seeing material increases in productivity, which in turn are driving corporate margins. And one thing, Joe, that's interesting for this year, corporate margins are projected to expand to 13.9%. So that is very positive and perhaps not fully reflected in that forecast. And then the other side of that is, of course, the midterms agenda and the fact that affordability is front and center. I think a lot will be done this year to try to shore up the consumer. So, how can you not be positive looking at that?
I like your view on AI as, it's stretched, and that is a risk to the market for valuations. At the same time, the payoff is going to start more than just trickling in for everybody else.
Yeah.
So it almost balances out. So the risk of a little bit of air coming out of the bubble is
Look, there are pockets that you have to watch, right? And when you look at, for example, late-stage AI valuations in private markets relative to earlier stages, for example, or non-AI valuations, there's a huge premium, something like 200% that we're seeing. So maybe you have to be watchful of those valuations. But at the same time, Joe, I think any of us around the table, we're likely using more AI this year than we did this time last year. And we're using it in more facets of our personal and professional lives. So as long as the adoption curve is rising, and as long as we're seeing tangible kind of productivity increases and therefore cost savings, I think there's this virtuous cycle that is playing out in AI. I will say for us at Partners Group, implementing artificial intelligence is a big focus across our portfolio companies. And again, depending on the company, the industry, the vertical, infrastructure, private equity, we are seeing 20, 30, 40% productivity increases. That is tangible because that accrues to the bottom line, even if it doesn't drive the top line just yet. But I think that is still to come. You
mentioned, so multiples stay the same and earnings rise 12%, but you're still only looking for 9%. So I don't know why you're not looking for 12%. And you also talked about margins improving, which could mean 12% it could end up being low for earnings per share growth.
Right.
So I just think you're still kind of safe at 9%, are you not?
Well, it is a baseline.
So multiples do come down a little bit?
I don't think multiples necessarily come down. The reason why we're looking for 7,600, 7,700 on the S&P is because it's not really the next year's earnings that are going to matter at the end of next year, but it's the year after that. So if you assume that 309, which is what we're projecting for this year earnings, that actually ends up growing another 10% in 2027, that's where you assign the multiples to. So that's what gets us to around 7,700.
When do we have a down year?
When AI disappoints. I think, that's probably the biggest risk in the market today because how much CapEx is related to artificial intelligence, how many efforts, across the economy are related to it. So I think if we do hit a hiccup, if we hit a disappointment, if we end up overspending and perhaps that we don't need as many semiconductors as we thought we did, or we don't need as much data center capacity. Perhaps there's a technology breakthrough. So that is probably the biggest identifiable potential catalyst for a down year. And of course, there's the unpredictable stuff.
Could we have a 10% move down, 15? move down and still end up at 76? That's Tom Lee.
I think so. I think so. I mean, take a look at last year, right?
Yep.
We had, a significant move to the downside, which ended up being a tremendous buying opportunity. But look, the stats are that every quarter, just about, you should have a 5% correction. Every year, you're likely to have a 10% correction. So we don't rule it out. But it's, and this is why, by the way, Joe, we've titled our outlook for this year, Investing at High Altitude. We're looking at high valuations. We're looking at tight credit spreads. So it feels a little, up there. But what do you do in that case? Maybe you have some dry powder. You're prepared to take advantage of some of those valuations. And I think, much like maybe our geopolitical approach these days, you want to be surgical and you want to be precise as far as what kind of opportunities you deploy capital to. We're finding plenty of those across sectors of private equity, infrastructure, et cetera.